Okay, how do you analyze a mobile home park to buy? How do you do the math? How do you do the underwriting to figure out, is this deal worth doing? Do the numbers actually work? So, we're going to dive into an Excel model here, and we're going to go over some assumptions. We're also going to cover some high level concepts and what you want to focus on when you're doing the financial analysis for this asset class. Okay, at the basic level, what is underwriting? You're just figuring out, does this deal work? Does it make money? Is it going to cover the expenses of the mortgage? Is it going to deliver a great return for our capital and especially for our investors' capital if we brought on limited partners? I suspect most of you understand the income approach and a cap rate, but just in case, here's a quick slide on that concept. Most people, before they get into commercial real estate, are used to the comparable method, comps. You buy a single family home. How do you figure out what it's worth? Well, you compare it to other transactions in the neighborhood. That's really not how we approach an investment real estate. We want to know what the net operating income of the property is. That, of course, is the gross revenues minus the expenses. In other words, what money's left over to pay for a loan from this asset. And then we can apply that net operating income, divide it by a cap rate, which is another way of saying what interest rate, so to speak, would we get on this asset if we bought it without cash. So if the NOI was $1 million and we paid 10 million, right, that would be a 10 cap rate. That would be the equivalent of a 10% interest rate on that investment. So there's the quick math at the bottom here for an 8% cap rate. Okay, here are the major operating expense categories. You can get some weird ones in this space, but these are the major food groups. Most of your expenses are going to fall in these subcategories. You have to know those line items extremely well before you buy a park. And then property taxes can be tricky if they're going to get reassessed based on the new purchase value. Each county is a little bit different in how they treat property taxes. So that's another one you're going to have to become an expert on your transaction. All right, here's some expense ratios. This is percentage of revenues. This isn't absolute. This is just rough ranges. I've seen direct billed utilities where the city is billing the tenants directly for electric, water, sewer. I've seen actually 20% expense ratios, but this is a conservative number. Some people will tell you that all mobile home parks run at 30% operating expenses, and that is not true. The vast majority of them are going to be closer to 50% than they are to 30% in my experience. But this isn't set in stone. It just kind of depends on each market. Each park has some quirks to it. For example, Texas has really high property taxes, so you can get higher expense ratios in that market. Whereas a state like Wyoming, they could be quite small relative to other states. And then the point on the right here, an older infrastructure just means you're probably going to have more leakage. And that is leakage literally as water is leaking out of the pipes. And so that often translates to missed opportunities to recoup that money from billing the tenants for their individual usage. And of course, an older park with older roads, you're going to have more repairs and maintenance line items, things that pop up like repairing potholes, right? And you'll have differing weather-related repairs and maintenance items in most markets. If it's a freezing market, you're going to have a lot of snow plowing. If there's a ton of trees in the park, you're going to have tree removal and tree trimming. So there's quirks here in R&M, of course, but here's the broad ranges. All right, let's dive into a quick model. This is more of a back of the envelope pro forma Excel model. This isn't a 10-tab, very sophisticated financial model. Your lender may or may not be okay with this. If it's a small deal, maybe. If they are a large lender, they're going to want something a little bit more detailed, but this is a good way to just understand the moving pieces, do a quick analysis of a property to get an understanding of what assumptions are going to drive the returns, to try to figure out, hey, am I in the ballpark here? Does this potential purchase even have a chance at being profitable and generating a great return? And so let's cover this at a very high level here. So you got your purchase price, $80,000 a lot. This is a 100 pad park in Anytown, USA. You have a lot rent, $575, and then you can put in, of course, your lot rent growth assumptions. We've talked about not making these crazy high assumptions. And then down below, we have our operating expense ratios. This assumption is, once again, very high level. We're just taking an absolute number here. Once you get the profit and loss statement, you understand the exact expenses. You're going to want to line item these out to know exactly what was spent per expense line item in the past. And then you can project what line items you should expect in the future. But once again, back of the envelope, this is a rough estimate. And typically you'll see operating expenses decline from the expense ratio margin. And it's declining because this can be common as you're increasing the lot rent, as you are growing ancillary revenue streams, as you're adding additional homes and occupancy. Not all the expenses are variable. Some of them are quite fixed, which is the great part about this space, is that oftentimes your revenue is increasing faster than your operating expenses, and therefore the ratio is declining. Doesn't always happen, but this is typically what we see. Okay, next, bad debt. You're never going to collect 100%, so that, maybe that's more like 3%. You'd want to also add a vacancy factor, just assuming that you're going to have some vacancy at all time at this park. There's going to be some sort of turnover, so you never really recoup 100% of expected revenues from your rent roll. All right, so we're 90% occupied. occupied. All right, lease up. This would be one lot leased a year, so one additional tenant per year. I think that's probably too conservative. Let's assume you're quite good and you do at least 5 a year. So you get to 100% occupied by year 2, the end of year 2. And of course, we can start to see what that does to the unlevered before debt and the levered, your total return profile, your IRR. Up here, we have the sources and uses. That is where the money is going, where it's coming from, what it's being applied to, your equity, the amount of money you got to come to the table with, your loan. And of course, this number's higher because you have closing costs and lender fees. All right, over to the exit here, the exit assumptions. We're assuming we have a 7-year hold here. And here's the exit cap rate, 5.5. Might feel a little light, but 100 pad park in a decent market, if there's some room in the lot rents, we're seeing that. Okay, maybe it's 6 to be conservative, right? Maybe that's aggressive. Maybe that's conservative. This is part of the art of underwriting. And so this is an assumption you want to play with, and you want to see how sensitive the deal is to that assumption. Ideally, it's not that sensitive to that assumption. Ideally, you're getting a lot of your return from cash flow from this asset that is not as contingent on the capital markets being there when you go to exit. Because if interest rates spike, we have some crazy inflation period again, then we're probably not going to have 5% cap rates. So long story short, you want to be thoughtful about your exit assumption, of course. But just as a sniff test, I like to show the gross sale proceeds per lot, right? So you understand what you're selling this thing for on a price per pad basis in 7 years. 112 a pad, you're buying at 80. This is not a crazy assumption 7 years later, especially if you are seeing other transactions, other parks in that range, in that state, in that region. And so knowing that number can get you more comfortable with your exit cap assumption. All right, this section is for what the park-owned homes, if there are any, what those are going to sell for. It's getting a little too complicated for this video, but you can play around with those assumptions, including what the park-owned home purchase assumptions are going to be and the growth of those rental rates. Okay, and then the nice part about this model is that you have dynamic debt assumptions. We're seeing a lot of deals that make sense to refinance over the next 3 to 5 years because the lot rents are fairly low. You're coming in with lower leverage. So you want to see what the refinance scenario looks like with new proceeds after you've done the business plan. And you can enter all those assumptions here, and you can size the loan based on the target debt service coverage ratio. That's a good meter on how much loan proceeds that you can push on a refinance, right? New interest rate on the refinance, interest rate on the current loan, LTV, the amortization, the balloon payment. So we have all the details on what it would take to finance this asset. So those are the major assumptions when it comes to buying a mobile home park. Let's see the output. I always like to keep it simple and just have a yearly schedule because there's not a lot of moving parts in this space. There is not a need for a 20-tab Excel file. Yes, if you are doing a ton of infill, there's a lot of capital requirements. You probably want to see the month by month so you know when the capital is going in and coming out on a month-to-month basis to really fine-tune the model. But if it's a really straightforward deal, monthly might be overkill for you personally or for your investors who might not be used to looking at large pro formas. Anyways, my point there is you don't want it to be overly complex. You want it to be as robust as it needs to be to get the job done. Okay, so we talked about infill. We said we were going to do 5 a year, so this thing's full by year 2. Here's the lot rent increases, right? And so you have your potential revenue for lots, your bad debt. We should have put this in here. You can fix that. This was a miss. This is something we would want to fix. We'd want to add a general vacancy allowance here, just to make sure that you're not assuming the thing's 100% occupied at all times. Okay, so then we have the acquisition financing. We have the debt scenarios here. In this case, we're assuming at year 5, we refinance. And so we have a couple years of the new loan before we exit in year 7 here. Now, if we wanted to say, okay, what if we hold it for 10 years? Right. And so then it's going to adjust all the numbers, of course, and you can hold it out here for a full 10 years and see what that does to the returns. And obviously you can go lower too, and you can get rid of this refinancing assumption. You can just assume that the current loan holds until your exit. And maybe you only analyze it at year 5. And of course, you can make that decision in year 3, 4, if you want to go ahead and refinance it or sell at that time. All right. So how are we looking here? Well, we have a deal that looks like 10% unlevered and a 15 IRR on a levered basis. So after your debt assumptions, right? Because you're using less dollars, obviously, to purchase it. So I don't know about you, but for vintage capital, that is an attractive return, especially we felt really good about the assumptions. It was in a market we liked. We would pursue this investment. All right. So that's a very simple back of the envelope approach to underwriting a mobile home park, to doing the analysis before you go ahead and submit your offer. And then once you get more details, the due diligence files, the profit and loss statement, the property tax, then you can prepare a more detailed pro forma and fine tune your offer. But many people in this space will make offers based on just that alone. But that's a pretty good start to really start narrowing in on exactly what you can afford to pay or what you're willing to pay to purchase that mobile home park. So hopefully that was useful. If you're looking for more resources, go to vintage-funds.com. All right, so if you want that Excel file, if you want to use it yourself, once again, don't use it for a $100 million offer, a big portfolio. But if you'd like it, go to the description down below, click on the link, and we'll send it to you. Thanks for watching.